Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Wednesday, May 13th, 2020. Figured it's a good time to do a video. There's some levels, developments I want to get out there, share my thoughts. I'm going to dive into the charts here. We'll focus on the broad markets and maybe touch on the VIX since it's related, and we also have an active trade on that. Let's start out by just going to today's post, what's been posted on here. That would be the most recent post. If I click on the home page, yeah, this one here. All right, so I did a couple homepage posts and these were the first charts put out earlier today. Let's start there. That was taken about just after the market. I wanted to see what would happen after the market opened, because that's when again all the players step onto the field. Take everything you see in the after hours and pre-market session and overnight futures with a grain of salt. If you want to see what I'm talking about, here was there was yesterday's close. And futures were up. Would have to show pre-market trades, edit chart properties. Let's do this. Post pre-market data. Always show last two sessions. Okay, here we go. All right, so here was yesterday's close right here. So you can see what happened on SPY. We drifted lower. Ended the last night's trading session right there, and the futures then started rallying, and we're up pretty strong, made a nice recovery, and it looked like if you woke up this morning, wow, futures are gonna poise to gap up above yesterday's close, but then all of a sudden they started fading it, and then you can see when the market opened, sharp drop right away. That's again, that's when all the players step onto the field, institutions, everybody. Then you had Powell flapping his jaw today. I warned about that yesterday. I said just about all the Fed governors or members, including Powell, were speaking this week, and so when Powell kind of made it clear to the world that they have no intention of taking the U.S. to a negative interest rate policy, everybody, cheered, or the markets cheered that briefly, and then again it was faded. And of course, it timed well with almost perfectly with the bounce. And again, I've done this too long to say that it's a mere coincidence, because the news will very often coincide with the charts, either lead it or sometimes follow it. Yesterday they had, what I read is everyone was putting their hands up saying they had no reason they could figure. In other words, they couldn't assign it and then a reason to the drop. But of course, as of this morning, I look and there were a couple of headlines saying, "Oh, the market's plunged late in the day due to, elevated coronavirus concerns." That's just, again, it's laughable. The media will slap on. They almost feel compelled to assign a headline or a cause for every major move in the market, whether that cause has anything to do with the move or not. Sometimes, like yesterday, those causes are technically based. We broke support. We broke that 60-minute little wedge right there, and had that dump into the close. And this was identified in advance, and there it is. That was your sell signal. So you don't see this on Bloomberg or CNBC that, oh, the markets fell because they broke a small, rising wedge after, several weeks of negative divergences building, and whatever. So anyways, I just want to mention that. All right, let's just talk about what happened and where we're going from here. All right, so that was this morning's chart, 15 minutes after the close. We hit support, at which point I said, the odds favored an elevated chance, meaning better than 50%. You get a reaction off that first level, and whether or not, I said, whether or not we get that bounce, the next sell signal coming to break below 83.90. So there was the bounce forecasted. And then after, of course, Powell's news conference, we got it. Coincided exactly with that, tag of that 283.90 level, or close enough again. There's the bounce about to where had it drawn, and then boom, and saying that would be an objective time to cover close any longs. If you covered, I like to as an active trader reverse on these initial tags of support. Not all of them, but the ones I think you're going to likely to get a bounce, cover shorts. And again, what you can do there is, if you're an active trader, if you're not, don't try to do it. It's difficult. But if you're an active, nimble trader, the SPY bounced, I think 1.25%, QQQ bounced 1.77% off those lows. So even if you only caught 1% of that, you turned around and you averted a 1% loss or give back. you turn that into a profit, so that's really extra 2% in your pocket, and then you reverse back long and then swung it on the way down. So you juiced up your returns on a swing trade. That's what active trading is all about. Whereas typical swing traders, you probably get chewed up and spit out if you try to get cute trying to game all the zigs and zags. So my suggestion is have a trading plan when you enter a trade, and that's what I post on these official trades. A trading plan consists of what you're going to buy or sell, in this case SPY, where you're going to buy it. There was a level. I've mentioned other objective entries. Wasn't around yesterday to post that. I was out of my office away from my desk when that happened, but obviously I said advanced. I believe that would be the next objective short entry. So you go look for these objective entries, and then part of a trading plan is where you're going to sell if correct. Now you can take profits at any or all of these. Some traders like to game quick bounces or quick shallow targets, get in, get out, in which case you should use a more aggressive stop. On this trade, I tuned the colors down, but it said stop 1 was back here on a daily close above that level. So anyone targeting only that first target from where we entered the trade originally should have already been stopped out of this and not been in there because the risk reward wouldn't have been favorable to short back here at 273.17, only to try to game a pullback down to 263 and a quarter, whereas somebody holding out for these T3 or T4 or even a bigger drop, maybe a test or break of those previous lows back in March 23rd, they could certainly use a higher stop there. And so again, the components of a trading plan are: what are you going to buy or sell short? Why are you going to do it? In other words, not just random, some type of technical catalyst, breakdown or breakout. Where you're going to pull the plug if wrong, and where you're going to take profits if correct. And again, there's a lot of ways to do this. You can take partial profits at each level, book full profits at any or all of those targets. You can game the balances. Again, there's many ways to do that. All right, so let's go on to look at QQQ. That was today. That was the second update there, and then had us going down here to hit 278.93, which again I think I just covered. Actually, we'll go down to the bottom of this post here because I posted some updates along the way, and that's what I want to mention. That not going to post a front page post every single time these little minor 1-2% bounces are likely, because right side of the chart, although I am an active trader and I know many on here are, it's mainly geared towards swing traders, trend traders, and investors. But so I will follow through here that as I did back then, that when that those targets were hit that I just showed you here, SPY 278.93, coming right up on it, very close, not all the way there, but and this is the important thing. This is why you're seeing me post usually at least 4 main charts when I'm tracking the broad market: SPY, QQQ, and their counterparts NQ, the Nasdaq 100 futures, and ES. Because as I said to somebody in a comment section today, that person said they only trade NQs, and I said, well, me too. I'll trade ES, I'll trade them all. I'll trade. Sometimes I see more meat on the bone for RTY, the small caps, or something else. But as far as trading QQQ over NQ, I like NQ because for various reasons: the leverage factor, the fact it can trade around the clock, I can control my stops at 3 in the morning. If there's a plunge in the futures, I can get stopped out. I don't have to wake up to a huge gap down against my position that will blow right past my stop if I was in QQQ, which has stopped trading overnight. And there's no way to control or minimize those losses. All right, so where I was going with is that's it. So that was today's kind of short-term active trading plan and levels to hit. Yesterday's breakdown followed into today, some follow through to the downside, followed by that bounce, which I said odds favored at that point off the initial tag. Again, initial tag at 283.90, and by initial, that's it. Usually once you hit a support, you get that little bounce, and then you go on and to break it, and the next sell signal came. So you could either recycle back into a long right here, or if let's say you missed the whole breakout yesterday together, you wanted now you wanted to short SPY. What the takeaway from this morning's first post would have been is don't short right here when we hit 283.90. even if that level could have broke, and I had an arrow saying, look, it could break, even though the odds favored a bounce, but Trading 101, it says you either buy a pullback to support for a bounce or you wait for a breakdown below that level, but you don't go short on support. Just like you don't go long on a bounce back to resistance. You either short that, sell your long, or you wait for a breakout above resistance to go long. So there's a lot of takeaways from these levels, and that's why I want to go over this in a video. It's can get my thoughts out there a little more, and that's it. So from there, we did go on. You had our little bounce, and right there, went down, bounced off that level, about where I had us going, and then went down here. And you can see again we were just shy, and this is where I was going with what I was talking about is why I use, watch all of these charts on QQQ. At the same time, SPY was just a hair above that support level. QQQ had a comparable level, which was highlighted quite a bit, including in last night's video. We had this what I call double gap support right here, gap there, that's the top of both of those gaps, so that line's extended out, and you can see QQQ made an almost perfect tag, a little brief momentum fueled overshoot. At the time I took the screenshot, we were right on that level, and so that's it. Having a little bounce, and I still think we get that. It could go more than that. I'm going to show you something to watch out for right now. Although, and let me get to that in a second. I'm going to talk about some divergences that have set up, potential divergences. And at the same time, or right before that, I posted that ES had just hit that 2806 support level line that was on that chart. It went down through the 2819, and it did that because at the same time NQ was overshooting. We were just, and I said at the time, we might get a brief what I call momentum fueled overshoot, which we did. So I'm going to get to these charts right now. Again, this I posted back then. I just want to mention, if you follow up in those comment sections or subscribe to it, anything that I add later, you'll get an email notification on that. So this is just kind of minor stuff, but it does play into where we're at right now. So let's take a look at the charts. This is live, NQ. All right, so what I do see here, and it certainly gives me, I don't know, say the right word, a little bit of pause in the near-term bearish scenario if these divergences happen to play out. What I'm talking about here are positive divergences. So we have positive, aka bullish divergences, but what I call, and again, this is just me, I don't think it's ever I've never seen this in the textbooks. Divergences in the textbooks. I didn't make up divergences. It's something learned years ago. It's very common in technical analysis. But I like to say the divergences are confirmed. We get that a crossover on the PPO because it's a momentum indicator. In other words, it can keep going lower. I know that you've been with the site for a while. You've heard me say this often, but so we could keep going lower and burn right through the divergences. But yet, if you get a bullish crossover in the PPO above the previous low right here, there's our previous low, and if we get a bullish crossover soon, that effectively puts in a higher low, which gives us the definition of positive divergence. Price is making lower lows, and the indicator is making higher lows. And so even if it only plays out for a relatively small rally that still falls shy of the highs, which is what I would favor, that could be something as an active trader you might not want to ride out. So let me just point out here, you can see the levels. 89.56 was resistance. I'm sorry, was support. That was the next target. Remember earlier today on those charts, that's how I posted us going down to next after the next leg down, and we had that again, what I call brief momentum fueled overshoot, a lot of downside velocity, a lot of momentum will carry a security down through the support level that will hold at least on the initial tag, even if you get a brief snap below it, and that's what's happened. But we're a little bit below that now, so this we need to watch and see. So we have kind of cross currents, if you will, technical cross currents. The bigger picture says we had long-standing divergences, even bigger than this on SPY and QQQ, divergences building for quite some time. In fact, we can take it back all the way right here. This is really, and that's what it looks like on my QQQ 60-minute chart. So we've had divergences building from this point in late April. I think that was April 29th, negative divergences. And we had little sell signals along the way, little trend line breaks, back tests, all that. And this is the one that did the trick. Just like I talked about recently with the all-time highs in the market back in February. We had divergences continuing to build. We had some sell signals. Hard to say which one will be the one that sticks, but obviously we know back in February, finally after those divergences continued to build, after we had some sell signals, markets pushed higher, the divergences stayed intact, and then finally one of them played out for the biggest drop that we've seen in decades in the market. And now, same thing here. We've had little corrections. We just set up new trend lines, and finally this trend line broke, and that's pretty impulsive. So that's kind of a wake-up call. It's a little different than these other breakdowns, and it means it's more likely to stick. We had this, what could be construed as a bear flag pattern, although it's very long. I'd say it's more of a price channel, and then boom, an impulsive breakdown through that. So where we're at, again, 89.56 and change, call it 89.5650, give or take a few points, was support, and we're trading right about on it now, maybe a little bit below it. And so that's going to be bearish if we can't get above it. I'm still favoring a little more upside, but I'm not sold on it. And if we can't get above it, what happens is we go down. We may take out these divergences with these indicators moving below these previous highs there. That's going to be pretty bearish. Look, do I expect a waterfall sell-off here? I'm open to any and all possibilities because I believe there's a huge disconnect between fundamentals in this market and where prices are. But I'm going to say the price action up until recently has been quite strong and bullish. In other words, been shrugging off these divergences. That doesn't mean that they just can't all of a sudden play out impulsively. So far they have. But what I wanted to say here is there's quite a bit of support on the way down. When you have a choppy trading range like we've been in for months, what it does, it gives you a lot of reaction highs, lots of gaps. You don't see gaps here on the futures as much because they're trading 24/7 other than the weekends, but you do see gaps on the indexes, and all those gaps are acting as support. So where I'm going with this is I lean towards more of a grind fest, and I'm near term. I reversed again on those levels that I just showed you, and NQ and ES. I'm favoring a little more upside, like I laid out on those charts, and it could be quite a bit more. So at this point in time, I may my current plan is just trail stops up and kind of watch the market, monitor as it goes. I'll let you know my thoughts before the close today. But as of now, I'm favoring more upside, but I can tell you this, if we can't regain 89.56, 89.57, and let's look at ES, and I'll go to the other ones as well, SPY and NQ, or SPY and QQQ. Here's ES, the S&P 500 futures. You can see the same potential divergences would be confirmed if the PPO can turn up, and that will only happen if we rally back up. So what happened is, earlier today, and actually for weeks now, I've had these levels here, support levels on ES, and we shot down through the 28.19 and hit this one about the time QQQ or NQ overshot those levels, and more importantly, right about the same time SPY almost exactly hit that target that was looked at earlier. And again, that's the takeaway. 4 different charts. Which one did the trick? These guys overshot. So if you were just trading, or if I was just trading ES and NQ in a vacuum, I might have said, wow, 28.06 broken, as well as 89.56. I'm going to stay short, or I'm going to add to more shorts. Then I would have gotten burned because we snapped back and we're back on those supports, or close enough to them to say that they've been successfully defended. And that's kind of the takeaway here, and that's why I use not just multiple time frames in my trading, but multiple securities that are really tracking the same indexes. And my answer to another trader who said he only focuses on NQ was, hey, I like NQ as well. It's probably my favorite index proxy. But the reason I'll watch SPY and ES and NQ and QQQ is that there are a certain subset of traders that only trade NQ. There are a certain subset of traders that only trade SPY, yet another subset of traders that only trade ES or QQQ. And so therefore, if all these traders, if there's more of them right now, or they just, at this point in time, they happen to put in bigger buy orders. Maybe it's it's a combination of institutional and individual investors, and they step in to buy 279 right there, which they did so far. Well, that's what halts the advance. So that's why when NQ and ES dipped down below those levels, and I said, and I said that in the comment section below that last post, that I would allow for a little momentum fueled overshoot and almost expect it, because you have the major index ETFs. You can see it's a pretty well defined support level right there. It's a gap, lots of reactions from above, Another big gap, a lot of reactions from below, another gap around that level, and about, a little bit above where we initially entered that short trade back there. So if you're confused on what my outlook is, because this is something else I get, remember, I try to speak clearly into the time frames that I'm talking about. You might be craving, Randy, how are you long now? You came into the day short. Yeah, you went long earlier, and then you went short again, and then you went long again. Cover those shorts. It's all relative to the time frame. And again, bigger picture to me, biggest picture are the weekly, even monthly, weekly, and daily charts that I've been covering quite a bit recently. 200-day moving average up here. You don't see it on this 60-minute chart. 61.8 Fibonacci retracement level. Back test of the 20-month EMA on the monthly chart. All this other stuff. Big overhead resistance levels, but very near term. Like I said, small divergences, but those divergences either could right away be overshadowed or overwhelmed by these larger negative divergences that are now appear to start to be playing out. Can't put the nail in the coffin yet, guys, because for the market, because we're still within this trading range. That's kind of the bigger picture, and it's kind of where I'm going is expect a little chop until we make a definitive break out of this range, either down below 273, we'll call it, or up above 295. That's our trading range. I'll box it in right there. There, it's right there. It's sloppy too. That's where somebody else asked. I said, look, some trading ranges are easy peasy. You get a price channel and the security is going up and down, or sideways trading range like that, and it's doing this. And when you recognize that pattern, if you can recognize it early on, great. It's simple. Go long at the top of the channel or a trading range, and then go short there. Cover your shorts and go long at the bottom. Ride your longs up, reverse to short. But that hasn't been the case here because it's not very well defined. We had reactions there, higher reaction low there, and right now, see, you might have made the case before that we were in a and it was a slightly upward channel. I'm going to say that too, slightly upward like this. Again, I can't draw perfect lines, but now we've cracked below it, and so that brings the that slightly near-term uptrend into question. Especially if we go much below this previous reaction low, then that brings it into question. So again, it's a sloppy trading range. What's the takeaway? If you are not an active, experienced trader, or even if you are, this is a good time to even take time off. If I didn't have the site, if I didn't have people buying monthly memberships that want immediate, constant trade ideas and action, I would take time off. I remember, in Reminiscence of a Stock Operator, one of the best books ever written on the markets. It was based on, loosely based biography of Jesse Livermore, a great trader who made a fortune, back in the in the 20s and the early teens and in the 30s. Anyways, where I remember a section where he had a heck of a run in the market, and didn't really see a lot of opportunities going forward, and took a couple months off, went down to Florida, rented a boat or bought a boat, and went fishing for a while and came back in. And so where I'm going with that is when the market's in these choppy ranges and there's not a lot of clear opportunities, there's not a lot of clearly bullish or bearish charts, the trend might be near-term bullish, but yet the risk-reward profile is abysmal. There's massive resistance overhead, so longs don't make sense in my opinion. And you can be short, which we are, but to be aggressively short when the trend is strong like that, and a lot of these recent sell signals really never followed through, isn't the best either. So that's it. I would just say I try to make clear when the opportunities are a little bit better, and they may be here soon now, because we finally, again, what happened is volatility has started to expand. So let's talk about that, and then we can maybe wrap it up. Let me make sure I covered all the levels with you guys. NQ, like I said, that's a big one. If we regain it and we do bounce, how far might we bounce? Where would be objective levels to short? If we got back here, that was a big level to me before, and still is, about 1911 right there on NQ. If we go lower, if we can't regain this level, or regain it and then fail, next support down here is about 88.30 right there, and you can see the lines. I think most of these are up to date, and again, kind of a lot of supply, meaning prices and support levels below, but that would be the next target. watch these divergences. If they don't pan out, then that's pretty darn bearish. So, and again, the overriding factor is we've had longer standing or building negative divergences. That's where they really started back here. And so that may overwhelm any buying or any bullish developments at this point in time. It's hard to say. I think we'll probably regain and bounce from here. And that's where I'm positioned now, but I may flip back by the time this video is over if I don't see, if I start to see us move lower and undercut these lows here. So those are the levels on NQ. ES, again, flirting with that 2800-ish support right there. Yeah, you always want to look at these reaction lows. That's where buyers will focus. I should put a line right there. And there's also some reaction highs right there as well. So we'll call that 2770 and then 2755 or so. Let's just focus on those for now. And then to the upside, should we bounce, you can see the resistance levels there. On SPY, I've been showing you different boards lately. A board is just a different drawing board with different lines. They have the official trade, which I was showing you earlier, that 60-minute chart, and then this one here I've had for a while, these purple lines that need to go. That was our, there was our sell signal back there. I talked about it. That's, that was a sell signal. It was a bearish rising wedge pattern, divergent high, broke down. Then we set up in the smaller wedge, and then that secondary sell signal or second sell signal came yesterday after a failure right about the same level. So again, it's not just about the 60-minute chart. When you go out to the monthly and daily and weekly charts, you see that these failures didn't happen at a random location. They happened at key levels on much more significant charts. Anything that happens on a daily chart is more significant and important than a 60-minute chart. What I mean by that, if I had a bearish engulfing candle on the 60-minute chart, yeah, that's worth noting, but it's much more significant if and when it happens on the daily chart like it did. And then yesterday I told you what I wanted to see is follow through, and that's certainly what we have here on SPY so far by a additional red candle. We'll see how we close the day. So again, I'm looking at viewing at any longs here right now, probably picking up nickels in front of a steamroller, and whether I carry those longs home tonight or not will depend on what I see into the close. And again, I may be out of those before then. But I also have, by the way, I wear different hats. I have multiple accounts, IRAs, other things like that, where I am short swing positions that I do not actively trade. I'm talking about my active trading account. Those, like I said, there's very little with this posture of the markets, technically as well as what's going on fundamentally, that will part me from my swing short positions right now. And we got room to add. There's plenty of room to add there. It's still, like I said, I'm willing and almost expecting to see a little more sideways choppiness over the next couple weeks here, but open anything. All right, one more. QQQ, bearish engulfing yesterday, as I mentioned, follow through today. Nice follow through. Like I said, the redder the better. So that all that does is there are no guarantees, but it helps to confirm or validate, let's say, that yesterday's bearish engulfing candlesticks in the indexes, QQQ, SPY. I imagine the Dow as well. I didn't look at that, but this is enough right there. So again, that helps to formulate the bigger picture, maybe a potential top. Whereas SPY and Dow, everything else has yet to take out. In fact, I've been testing the 200-day in the SPY. You have, as you can see below, if you're wondering maybe a potential swing target for the Qs, look at these two lines. These red lines are the 200-day simple, 200-day exponential moving average in red, and the 200-day simple moving average in blue right here. And they both come in perfectly together. And I say that some traders like to use the 200 simple, some like to use the exponential. And because of that reason, I like to use them both. And you can see they do a good job, a very good job of acting as support and resistance. If you bought the pullback to the 200-day there, we undercut it intraday or briefly on the exponential, reversed right off the simple there. Here, we didn't get to the simple. We reversed off the exponential. Those were great buying ops, even for a quick trade. And we did that. We went long, an official long trade on the Qs right there and caught that rally. And then we turned around, we went short the Qs right there after the bounce and got out, not at the exact highs, but darn close to it. So we captured most of the bounce to the upside and then put an official short trade on there and got in short for the next leg down. But again, you go back in time and you see, these lines work well. So where am I going with that? Again, you want a swing target. You don't want to worry about that 20 plus minutes of short-term levels and maybe bounces and little micro bounces. It might be 1, 2, 3%. You don't want to try to game that and get chopped to pieces. Then here's a potential target for the Qs right there, even if you're bullish and you think the market's going to new highs, or if you're bearish but you don't want to, you just want to make a quick let's see, how much would that be? That would be a drop of about another 7.7% or so, almost 8% down there. So there's some levels to watch. And again, TVIX is a good example of why I will sometimes get into a trade before there's a solid sell signal, when the charts to me seem compelling, or at the very least the risk reward is attractive. Same with shorting the broad markets, as I said for weeks now. If those shorts, at least on the SPY, some of the other shorts have panned out so far, Berkshire and Verizon and some other ones, and some that we've closed out. But the point is that there are times where I'm not in front of the desk. I have to do errands. It's also not healthy to sit in a chair for 10 hours a day, every day. So time to time, I do like to cut out during the day and stretch my legs and go out and have lunch or run errands and all that. And therefore, I would have missed out on this, as I've been waiting for that breakdown in SPY. Guess what? I would have missed it yesterday. I would not have been into TVIX, which I already was, and it's run up 47%. Even yesterday alone, it ran up from the lows there just before, or well, let's say from where the market broke out, probably was about right here. That's when it started ripping up, and it rallied about 23%. Guess what? If I came home, even if I got home right before the close or after, I probably wouldn't want to buy it after a 23% move. And so, in just one fell swoop, this thing went from recovering our loss, just barely averting our stop, to turning profitable. And that's an example of why, at least in my trading style, I'll get ahead of some trades sometimes if they look compelling. And then again, somebody mentioned, hey, scaling in, and yes, that is a big, somebody in the comment section mentioned that, and that is a big part of my trading. I scale in. I just don't always do that in the official trade. I think it's confusing enough to some people as to why I have multiple targets, exit points, and sometimes multiple stops, and for the official trades to try to manage it with multiple entries. Now, I do always point out objective entries. I just try to keep the official trades limited to one official entry price, but I will, once the trade gets going, point out pullbacks to support or resistance on longs. For example, if TVIX were to pull back to 177.28, that may or may not offer an objective entry. Why did I say may or may not? Well, if it did, I would look at SPY, ES, NQ, QQQ. At the same time, if they were to be pulling or rallying up to resistance levels that I just showed you that would provide objective short entries, that would make it all the better, as far as adding to a TVIX trade on a pullback to support. That may or may not happen. Markets may continue lower from here, and TVIX may continue rising. But as far as objectiveness, you need to wait to see if these levels give way in the broad market. If they do, you'll probably see more buying as people scramble to, buy put protection and unwind all their calls. That's what happens after a period of extended volatility, low volatility. And when you finally see volatility spike. And again, the basis for this trade was based on the VIX itself. TVIX is just one of several ETFs or ETNs that track it. And, we entered this not too long ago. It was down. I pointed out that, the VIX itself went up to right about to its 2008 all-time highs. And at that first pullback, it dropped about 63%. At the time we entered TVIX, it was down 64. I think it went on to drop another 5%, which is almost immeasurable, because of VIX, the price range from this thing, from top to bottom of the range is, over 600% just from that point, not the very bottom of the range. And so that is, basically everything is kind of what I'm getting at. Everything is kind of fitting the pattern of previous bear markets where you have, an initial surge, extreme, where a bull market, at the end of a bull market, just about everybody's caught off guard. Most of the shorts have given up. Everybody's buying calls because they think the market will go up forever. Very few put buying. And when you have that sudden sharp drop in the market, that's where the VIX explodes, is both individuals and institutions are having to cover their butt, protect their losses. So they're buying puts. more puts than calls, and that's what makes the VIX surge. And then again, you get the first bear market rally, and everybody thinks the worst is over, and the VIX drops hard. And again, it's just kind of a repetitive pattern, and so whatever, that was the basis for that trade, whether it works out or not. All right, let me wrap it up here. Those are the levels, and like I said, TVIX, if it keeps going up, whether or not it keeps going up from here will depend likely on the broad markets. If they're going to break those support levels they're testing as I started the video, or if we're going to get a rally and those little 60 minutes divergences play out for a bounce, then you could see this. There are times too where the market rallies and TVIX or the VIX doesn't give back anything, and that is a rally that very few believe in. So what happens is the market may bounce, but people continue to buy puts, more puts than calls, and that keeps the VIX up at that point in time. So we'll see what happens. But yeah, takeaway is don't, if you're an active trader, you can try to game those. But if you're a swing trader and you entered wherever you entered TVIX, have a trading plan. Is this your target? Is this your target, or this, or all three? Do you plan to take partial profits? Each one's hit. Stick with your trading plan unless something compelling changes. Something compelling would be, for example, a solid break above the 200-day moving average on the S&P 500, things like that, which might say if that happens, the VIX probably, even if it gets there, we're probably going to go down lower. But as of now, this looks like the most likely scenario, and there's still plenty of meat left on the bone on this trade. Another 22% or so to T1, 49% to T2, and about 100% from where we're at now if T3 is hit. So we'll wrap it up here and get this video out to you guys. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.